I think a big benefit of what we've provided people is that they are more likely to be able to relax, feel like they're going to be okay, and real, soft stuff. I mean,
you can relax in the sense that you know the animal that you're riding, and it could turn out well, it could turn out badly over short periods of time, but it is the animal that you know. I mean, the kinds of products that we deliver aren't really based on a black box of some sort. If you were picking stocks from among the value group, then there's some unease about whether the picking is really any good. But we take that right out of the game and say, no, we're going to deliver the whole area, the whole thing. I think that's the big challenge for advisors, is figuring out what kind of risks their clients are willing to take. Every time I talk to the new financial advisors looking at dimensionals, I tell them that's your biggest problem, or that's your biggest challenge, is getting your investors, your clients, to understand the dispersion of possible outcomes associated with different mixes of stocks, bonds, and all the dimensions of risk and return.
That's one challenge, but there's another, is the manifestation of those outcomes, right? I mean, a big challenge for an advisor is to help their clients understand that this was a normal outcome.
Right.
And that, no, we don't need to adjust our portfolio because this quarter it went down.
Right.
This was in the range of perfectly reasonable outcomes.
It's always a very difficult process and difficult experience for clients to stay in markets. If markets are good, there's a lot of energy around putting more money into the market. When market's bad, the energy is around taking the money out. We had a very traumatic experience in the markets back in 2008 and 2009. Once the markets dropped, a lot of clients actually bailed out of their equity mutual fund positions. What we saw on the opposite side with Dimensional and the advisors working with their clients was just the opposite. Clients and advisors stayed in the markets, and the rebound in the markets from March of 2009 forward was dramatic. And fortunately, the clients who kept their assets deployed in the market were able to benefit from that increase. What the advisor does is spends time with the client, basically gives them discipline around the process, and really helps the client stay in the markets through good markets and bad.